You ever watch the market just go nuts? It'll suddenly tank, or maybe it'll skyrocket, and there's absolutely no news, no reason you can see for it. It feels totally random, right? Maybe even a little rigged? Well, what if I told you it's not random at all? Today, we're going to pull back the curtain on the hidden engine that is really moving stocks. Look, we all learn the basics. Stock prices move because of earnings reports, big news stories, economic data, that kind of stuff. But what if a massive part of the daily price action is driven by something else entirely? A force that doesn't care about a CEO's interview or an analyst upgrade. A force that's just pure math, running on rails in a market that has gotten so huge, it now controls the very thing it was supposed to track. You're going to hear this phrase a lot because it's the key to everything. The dog, that's the stock market. Apple, Tesla, the S&P 500. The tail is the options market, the derivatives. For decades, it worked like it was supposed to. The dog wagged the tail. But not anymore. That relationship has completely flipped on its head. The tail is now violently wagging the dog, and once you see it, you'll never look at the market the same way again. So how in the world did we get here? Well, options used to be pretty simple tools, mostly for big players to hedge their risk. But then trading volume just exploded, and as it got bigger and bigger, it created this powerful feedback loop. Now, the mechanical, have-to-do-it actions needed just to keep the options market running are forcing billions of dollars to flood into or out of actual stocks, literally creating the wild price swings we see every single day. Okay, so to really get how this works, you have to meet the people at the center of the storm. They're not bulls, they're not bears, they don't bet on the market going up or down. They're just the house. They are the options market makers. Think of an options market maker, or an OMM, like a giant casino bookie or a massive insurance company. When you, a retail trader, want to buy an option, they're the ones who sell it to you. When you want to sell, they're the ones who buy it. They're always there, making sure there's a market. Their job isn't to be right about the direction, it's just to make a tiny little profit, the bid-ask spread, on every single transaction. And now we get to the absolute secret sauce of their business model. Step 3, hedging. Because they are on the other side of millions of trades, they take on a mind-boggling amount of risk. To avoid blowing up, they have to get rid of that risk instantly. And how do they do that? By buying or selling the actual stock that the option is based on. This forced mechanical hedging, that is the transmission mechanism. That is how the tail wags the dog. So how do they know exactly how many shares of stock to buy or sell? It's not a gut feeling. It is all dictated by a set of hardcore mathematical formulas known as the Greeks. This is the secret language, the code, that forces every single move they make. The first and most basic Greek is delta. All delta does is tell the market maker how many shares of stock they need to buy or sell to perfectly balance out the risk of an option they just sold. So for example, if they sell you a call option that has a delta of 0.50, they're required instantly to go out and buy 50 shares of that stock. That keeps them perfectly neutral. It's their first line of defense. But here is where things get really, really wild. What happens when the stock price actually moves? Well, that delta number, it changes. And the Greek that measures how fast delta changes is called gamma. Gamma is the accelerator pedal. When gamma is high, even a tiny little move in a stock's price can make its delta just explode, forcing that market maker to frantically buy or sell a ton more stock just to get back to neutral. Gamma is the switch that determines whether the market is stable or pure chaos. And this brings us to the absolute heart of this entire explainer. You see, the total gamma position of all these market makers can literally flip the entire market into one of two completely different modes. In one mode, it's a giant shock absorber. In the other, it's like pouring gasoline on a bonfire. This is the market's split personality. When we're in a positive gamma world, dealers are forced to trade against the prevailing trend. They buy the dips and they sell the rips. This acts like a giant brake on the market, tamping down volatility and keeping things calm. But when we're in a negative gamma world, everything flips. Their hedging is forced to chase the trend. They have to buy stocks as they're screaming higher and sell them as they're crashing lower. This is the gasoline on the fire. It amplifies every move and creates absolute chaos. This negative gamma state is what fuels the famous gamma squeeze. We all saw it happen with GameStop and AMC. It starts when a ton of people pile into cheap, out-of-the-money call options. The dealers sell them those options, and in the process, take on a massive negative gamma position. Then, as the stock starts to tick up, that accelerator pedal gets slammed to the floor. The the gamma goes crazy, creating a vicious feedback loop where dealers are forced to buy stock, which pushes the price higher, which makes the gamma go even crazier, which forces them to buy even more stock. It's an explosion that has nothing to do with the company's fundamentals. So if gamma is the accelerator pedal, a brand new financial product has basically put that pedal on a hair trigger. And I'm talking about the revolution that is zero-day to expiration options, or as everyone calls them, zero DTEs. The scale of this is it's staggering. These are options that expire on the very same day that you trade them, and their popularity has just exploded. They now regularly make up more than half of the entire daily options volume on the S&P 500. This isn't some niche product. It's a seismic shift in the market's plumbing. The amount of money we're talking about here is almost impossible to wrap your head around. The daily notional value of these contracts, that's the value of all the stock they represent, is around $1 trillion per day. To put that in perspective, on a lot of days, the value of these one-day options is bigger than all the shares traded on the New York Stock Exchange and the Nasdaq combined. It's insane. Now, here's why that matters so much. Remember gamma? Well, the closer an option gets to expiring, the higher its gamma gets, and you literally cannot get any closer than 0 days. With just hours or even minutes left to live, these options are hypersensitive. This means zero DTEs have astronomical, off-the-charts levels of gamma. It takes those powerful forces we talked about and turns them into an intraday, minute-by-minute battle. It's the same game, just played on hyperspeed. So let's tie this all together. What does this all mean for you? It means the fundamental structure of the stock market has changed. This simple story we all learned about buyers and sellers and fundamentals, that's just not the whole picture anymore. Not even close. Okay, so let's recap. First, the options market is not a sideshow. It is a primary driver of stock prices. Second, the forced mechanical hedging by market makers literally creates trends, and they do it whether they want to or not. Third, the market's entire personality can flip on a dime, from stable and calm to chaotic and wild, all based on its gamma state. And finally, the explosion of zero DTEs has put this whole machine into overdrive. Look, understanding these hidden flows is no longer just an edge. It is absolutely essential to navigating the market today. And that kind of leaves us with one last big question to think about. If there is a $1 trillion river of money flowing through the market every day, and its direction is being dictated not by human analysis or economic news, but by the automatic reflexive hedging against pure mathematical formulas, who or what is really in control of the price you see on your screen?